Hello traders, welcome to today's webinar. So before I begin again, let me know if you can hear me well. So please type 1 if you can hear me well. Hello home sweet home, good afternoon to you as well. And good evening here from the Philippines. Hello Harley Dimaangay. So you will receive a copy of the PDF on our Telegram channel. So if you are not a part of our channel yet, so I encourage you to please join, and you may find the link on the description box below. And about your question, how does actual trading work? So it is about buying and selling currency pair, just like what you said. It is the exchange of one currency to another. And we are going to discuss more of it later. Especially that our today's topic is all about Forex analysis. Okay, so again, please type 1 if you can hear me well. Hello to you as well, Rebecca. Hello, Sir Lito Mateo from Tublay-Benguet. Okay, so before begin again, for those who are brand new, what you are going to get from these webinars are first the chance to win the 100% deposit bonus. So I'll give the promo code for this one later. So after attending the lessons, you may use that promo code for 100% deposit bonus to double your deposit, and as well as certificate of attendance. So if you attended our first webinar, so I encourage you to please join us up to Friday after the last webinar, which is our fourth webinar this coming Friday, for you to receive this certificate of attendance. If you are brand new today, so you can watch our first two webinars on our YouTube channel. And of course, the $100 deposit or giveaway. And this is, you can win this $100 giveaway on your trading account, on your live trading account, if you join our speakers task, my task. Okay, so all you have to do is to complete them on our Telegram channel. Then we will choose the winner using random generator. And of course, just like what Harley is asking earlier, the trader's guidebook in PDF format. So later I will send you the first 3 PDF guides from our previous 3 webinars. So this is the third, right? So the first 2 lessons will be provided later together with this one. Alright, so please type in your name together with your address or where you are watching today. Hello, Papu Boy. So nice to see you again. Again, please type in your name together with your address or your city, wherever you are watching today, so that we could greet you. Hello, Elijah CN. So I think Telegram link is I'm not sure, but I think it is working. So please try to join it again. Hello to Aja Nakumuyiwa from Nigeria. Hello from Arifur from Bangladesh. So welcome to this webinar. Hello to Suhas from India. Hello to Joseph Dimarukut from Parañaque City. Hello Faisan Ali, aka Home Sweet Home from Pakistan. So glad to see you again, Home Sweet Home. Hello Elijah from Daet Philippines. So I guess you already know who I am, but in case you are brand new, again, I am Paul Joseph Mendoza, or you can call me PJ or Paul. And I have 6 years of trading experience. I am trading here in OctaFX since last year. Hi to you as well, Muhammad Ali. All right, so for today, what we are going to discuss is all about Forex analysis. Hello, Home Sweet Home. So thank you very much for your kind words. So don't worry, we will have lots of webinars in the future, I hope. But in Friday, we are going to end this series. So hopefully we can have a brand new series in the future. Just check and stay connected on us via our social media platforms. And you may also check our website in case you want to anticipate the upcoming webinars. You may also watch other speakers here on this channel. You may also find value with them on their teachings. Okay, so back in this content. So we are going to talk about analysis, how to analyze the Forex market, what is a technical analysis, what is fundamental analysis, as well as market trends and chart patterns. So if I'm not mistaken, last Friday, there's someone who is asking about chart patterns. So if you are here today, please type in your name. And we are going to discuss a lot of chart patterns for today's session. Okay, so we all know that fundamental analysis is very, very important on our trading activity, right? Because we are just not blindly clicking the buy and sell button. We should have a proper trading system, including technical analysis, of course, as well as some touch of fundamental analysis for us to have a better view on the market and a better trading decision, whether to buy or sell. Right? So to start, so Forex analysis is used by retail Forex day traders just like us to determine whether to buy or sell a currency pair. So If you are seeing that the price is going up, so this is what we call the technical analysis, in which we are using price action, right? But on top of this, we are also using fundamental analysis. So in this case, we can see that fundamental analysis is what really happening on the real world, while technical analysis is the representation of those things. So for example, we have this macro data or macro analysis. So in this one, we are studying or analyzing the policy objectives. We are also analyzing some financial policy of that specific country. So just like in stock market, so if you are a stock trader, so you are analyzing the financial statement of the company, right? You are analyzing or trying to analyze the situation of that specific company, right? But in Forex, you are not just analyzing a single industry. What you are doing is you are trying to understand the whole situation of that specific country. So for example, here in the Philippines, we just held our election last year, and we have a new president, and because of that, there's a lot of new investors who invested in the Philippines. There's also some old investors who pulled out their investment, while other investors added some of their investments because in their minds, because the Philippines changed their president, that president will likely do something better than the the former president, right? So that's the 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 narrative, or that's the thinking, the mindset of the former and newly investors. So that's what's happening on the real world. Okay, so we are analyzing something like interest rates, something like um, just like what I said, political change of scenery, something like that. And then there's the favorite of every traders out there, which is the technical analysis. So in this one, we are analyzing the graphical analysis or something like price action patterns. We are also using some indicators, and we are also using some volumes. Okay. So first, let's discuss what is fundamentals. So fundamental analysis is a way of looking at the Forex market by analyzing economic, social, and political forces that may affect a currency prices. So currency rates, the basic instruments of the foreign exchange market, are affected by major financial news and fundamental statistical reports, and as well as geopolitical events. So this is what I'm trying to say earlier. So in this case, major financial news is also a very, very good indicator for us fundamental traders. And you may find the links right here, or the websites in which you can see some of the some of the major news release or events, such as on our very own octafx.com/markets/news. You can also find some information on investing.com, Bloomberg, Daily FX, FX Street, and I think this is by far the most popular, which is forexfactory.com. So later we will try to use some real world example. And just like what I said earlier, one of the many reasons on why price action is moving is because of interest rates. And there are 8 major central banks who are the biggest participants in the Forex market. So the first one is the Bank of Australia, which is RBA. So by the way, please be familiar with the abbreviations, because most of the time analysts are only using abbreviations instead of the whole, something like this, European Central Bank. So it's long, right? So instead of saying European Central Bank, what they normally do is to just say ECB. Okay? So again, RBA is for Bank of Australia, BOC is for Bank of Canada, ECB is for European Central Bank, BOJ is for Bank of Japan, RBNZ is for Reserve Bank of New Zealand, and so on and so forth. And this is the most popular, which is the Federal Reserve from the United States. So, so anytime that one of these major banks increase their interest, so once they rise their interest rate, so for example, the price is just moving sideways, but the Fed decided to raise their interest rates. So normally, what the investors or the traders normally have this thinking that the price could go up, and they are looking for a pattern in their chart, and this is how we can combine fundamental and technical analysis. So, for example, Fed decided to increase their interest rates, then a trader may find a flag pattern like this. So because the Fed increased their interest rates, there's a high probability that the price could go up. So in that case, what traders are doing is to put a buy stop order here. So if you remember on our previous webinar, we discussed how to place buy stop and sell stop order as well as limit orders. Then once the price reacted from the news, and then if you put a buy stop order at the top of your resistance, because the Fed increased their interest rates, there's a high probability that the price could go up. And then once the price reacted into that news and you put your buy stop order here, the price could reach your buy stop order. And then if the price goes on your favor, you can earn much bigger trading this strategy rather than trading just the technical analysis. And this is also important because in case you are analyzing that the price could go down, but you are unaware that there's a high impact news which will be announced later, and then you are anticipating a breakout at the bottom, and then you put your let's say sell stop here, and then you put your stop loss here, then there's a chance that you will lose big, right? So this is the importance of using fundamental analysis rather than just sticking on technicals. So in my case, again, just like what I said earlier, before, I am using 30% fundamentals while using 70% technicals on my own trading. Okay, so how to use the fundamental analysis in trading is, first, we can look for the events of the week or the day. We can analyze the whole Forex market for the entire week. We can also focus on the high impact event. So later I will show you how to do this one. Confirm release time and understand the meaning of the event and the possible outcomes. Take note of the previous forecast, and the thing that happened before. You may also use it as an indicator on what's going to happen next. Then wait for the news release, then combine those things with technical analysis and your strategy. So just like what I showed you earlier. So let me show you how to do this on the chart. So for example, here on the Aussie Canada, so yesterday around 12:30 Philippine time. So here on the octafx.com/markets/economic calendar, you may see your economic calendar right here. And then as we can see, yesterday, the RBA has this interest rate decision. So this is a high impact news, right? So because this is a high impact news, then once 12:30 comes, you may want to look for a pattern, or you may want to stay away. If you are not comfortable trading the news, then you may want to stay away first on the Aussie pairs because this is a high impact news. So this is also one good thing about fundamental analysis. So other traders are also using this one as an indicator whether they will trade or not. So as we can see, the forecast is 3.6%, but the actual data release was 3.85%. So this is bigger. The actual the actual release was bigger than the forecasted. So because of this, the price of the Aussie pairs goes up because of this high impact news. And if we look into the chart, so we can see here that the price formed a something like lower trend line here while establishing a base right here, which is a strong support. So before 12:30 comes, we can see that the price is on a downtrend, right? But after creating a new low right here, so we can see that the price breaks this previous low, and it is consistently breaking its previous lows right here. But come into this level, the price can't move lower than this support, right? So this is the base that the price has created. And before 12:30 comes, we can also see that the price is now rejecting or breaking this resistance right here. So the price created a new high. So after creating some lower highs and lows, and then the price created a strong support right here, and then we can see that the price before 12:30, it has created a new high, right? So we can see that the price has created a new high here. Then the price tried to make another low, but the price failed to break this established low that we have right here. And then 12:30 comes, and then as we can see, the price goes up in this in just the single candle. The price goes up to 74 pips. So in 5-minute time frame, this is very, very unusual. The price of or the normal single candlestick will go up to just 3 to 5 pips in the normal situation. So just like what we can see here, the price or the candlesticks are just smaller, right? But because there's a high impact news, we can see that this single candlestick alone goes up to 74.6 pips. So this is what fundamental analysis is very, very, this is how a fundamental analysis could be useful for us traders. Okay, so again, what we can do here is, for example, you are anticipating this high impact news, okay, and then you are waiting for the news to be released. So this before 12:30, so this is what we can see. Okay, so let's just assume that we are just here right now. So before 12:30 came, we can see that the price is on a downtrend, but once 12:30 is coming, or once we are going near 12:30, we can see that the sentiment of the price action is now changing, right? So the first indication that the price could go up is, first, the price failed to make a new low right here. So the price established a strong support. And then we can see again that the price breaks its previous high, or the price breaks its resistance. The price created a higher low right here, or a higher high rather. And then as we can see, once the news has been released, we can see that the actual forecast was higher than the expected. So in that case, what you can do again is to put a buy stop order at the top of your resistance. So in this example, let's say that you put a buy stop order here, and then for you to just be safe, because sometimes there's a tendency that the price could go up and then goes down again before continuing to go higher. So in this case, what you can do is to put your stop loss below the swing low, okay, for you to be able to be protected with the volatility. Okay, so let's say you put your stop loss right here. You can put it, because this is a high impact news, this is very, very volatile, so you can put it So let's say 10 to 20 pips below the swing low. So in that case, you will put your stop loss in this level for you to be able to be protected from the volatility, because again, there's a chance that the price could do something like this. After breaking this resistance, the price could trigger your buy stop order. Then because of the high volatility and because this is a high impact news, sometimes there's a tendency that the price could go up and then it will go down. It will sweep some liquidities right here at the bottom of this support. So for you to be able to avoid that, you may want to have a bigger stop loss placement. So in this case, we can see that the price continue to go higher up to this level. But if you want to trade this strategy, I suggest just look for the previous highs and then put it or use it as your target. Okay, so in this case, you will have 1:1.19 risk to reward ratio. Okay, but if you don't want putting some target, because again, this is a high impact news and the price could go up higher than we expected because the actual rate is higher. So what you can do is to use moving average, and then what we can do here is to use it as a trail stop. So in this case, let's say we put our buy stop here, and then we are waiting for the crossover of the moving average. So in this case, I am using 20 and 50 EMA. So let's say, for example, once the EMA cross, so in this case, we can see that the EMA cross right here. So this is where I can take my profit. Okay, so in this case, what we can expect is for us to have a higher risk to reward ratio. Okay, so if you don't want using some TP, or if you don't want using take profit orders, what you can do is to use moving average, and you can use crossovers for you to identify if you want to take your profit. Because after the high impact news, after the news has passed, we can see that the price just goes sideways. And we can see that the price is now moving just, it is moving like this. And we can see that we don't have any opportunity for this one right now. Okay, so that's how we can trade the news. That's how we can trade fundamental analysis. So again, you can use fundamentals for you to be able to take advantage of this high impact news, or you can also just avoid trading at all, because we all know that trading high impact news carries a lot of risk, right? So other traders just prefer not trading at all if this is the case. But if you want to trade it, then you can do the strategy that I showed you earlier. So let's try to look at other Australian pairs. So here, just like what we have from the Aussie Canada, here on Aussie dollar, we have the same situation. So before 12:30, the price is on a downtrend, right? But once 9 a.m. comes, or while we are nearing 12:30, we can see that the sentiment of the price action is changing. So in this case, again, the price breaks its resistance, and then we can see that we have a lower channel here, or a trend line right here. So in this case, what you can do again is to put a buy stop order at the top of your previous high, or you may also put it at the top of your trend line, which is right here, and then put your stop loss below the swing low. So we can put it 10 pips below. So in that case, we will have 26 pips for our stop loss. So in 5-minute time frame, it is not normal for you to have 26 pips stop loss. But because again, this is a high impact news, it will be very useful and helpful for us traders, especially in 5-minute time frame, to use such a wide stop loss. Okay. And again, if you want, you can use this previous high as your target, or if you don't want using structures as your take profit levels, you can use again EMA. And then in this case, we can see the 20 and 50 cross happened right here. Or if you want, you can also use the breakout strategy on the EMA. So in this case, once the price breaks the EMA right here, we can then take our profit. Okay, so that's the exit strategy that we can use. So if we use this breakout strategy on the 20 MA, then we will have 1 is to 2.16 risk to reward ratio. But if you use the crossover method, which happened right here, then you will have 1 is to 2. Okay, so in that case, we can see that this is a possible strategy if you want to trade high impact news. But if you are going to ask me, I prefer not trading high impact news such as this in case there's a release. So as we can see, there's another right here from the euro, and it happened 5 p.m. And then we also have a high impact news. I believe it is today. So let's see. So here, as we can see here from the New Zealand dollar, pair, they they are anticipating a 0.4% change on their unemployment rate, but we can see that the actual release was 0.8%. So if we are going to look at this right now, so let's try looking at the New Zealand dollar, and let's try to see what happened on the price once that high impact news was released. So let me just go back here. So I believe it was right here at it was 6:45 a.m. So 6:45 a.m. was right here. So by the way, that's how we can use high impact news and fundamental analysis. Okay, so for us to be able to move on quickly, so right now we are going to talk about technical analysis. So technical analysis is the study of historical price action in order for us to identify patterns and determine probabilities of the future direction of the price. So this is the study of the past movement of the price action. So for example, we have these swing highs and lows. So we are going to study the DNA of the price action, or the historical data that the price is showing us. And then for us to be able to decide whether to buy or sell, then we will try to analyze what happened from the past data. Okay, so technical analysts look for similar patterns that have formed in the past and will form trade ideas. So believing that the price could act in the same way that it did before. So this is what I am trying to explain. So what you need to do first is to identify trends, support, and resistance. And then you may also use indicators such as moving average. And then, of course, this is the most popular of every retail trader out there, which is chart patterns and as well as candlestick patterns. So we are going to look at this one. Here, for example, we have the three types of market trends, and we can see a lot of patterns here. So the first pattern is the uptrend. Again, so the uptrend. So uptrend consists of higher highs and lows. So as you can see, we have this 1, 2, 3 pattern right here. So this is what I call a 1, 2, 3 pattern. So this is the one. Your pullback or your first correction move is your second move, which is your 2. And then your third move or your third impulsive move will be your 3. So in this case, we will have high or in this case low. Then we have high here. Then we will have a higher low because this new low is higher than the previous low. That's why we will call it higher low. And this new high right here is higher than this previous high. So in that case, we will call this a higher high. Okay. So in this example, we can see that we have it right here. So we have low and high right here, and then the price created its first 1, 2, 3 pattern. So we have created our first higher low, then we have our second higher high right here. And then what you need to remember in technical analysis is that there are 6 tenets of Dow theory. So Dow theory is the common ancestor to most principles of modern technical analysis, just like what I showed you earlier, and the general line of trend analysis. So the 6 tenets of principles that would be applied to Dow theory are: market discounts everything. So there are 3 types of market trends. So primary trends are split into 3 phases. So later we will discuss these 3 phases. And then indices must confirm each other. Volume should confirm the price. And lastly, trends persist until there's a clear reversal. So this is where most of the traders find it difficult, because if the price is going higher, some of the newbie traders are thinking that the price is too high. So they are trying to sell the trend. They are trying to sell on an uptrend, and they are trying to buy every time the price is going down. So this is very, very dangerous, because trends persist until there's a clear reversal pattern or a sign of reversal, which is, again, we can use a touch of fundamental analysis right here. So in this case, in case you are using technical analysis, for you to be able to identify once a reversal is happening, then you may want to look for a breakout of the previous highs or lows. So later we are going to discuss that one. So back on this one, so let's try to look at the live chart. So going back into the New Zealand dollar, so we can see that we have an uptrend right here. So let's just focus on this one right now. So this is, as we can see, this is our low, right? So this is our low. And then the price established its high right here. So remember, we have it right here. So this is our low and this is our high. So this is what we call R1. Okay, so this is what we call R1 move. And then going back on our live chart, so in this case, this is R1. Okay, so in case you are brand new, we already discussed this on our previous webinars, but for the sake of this webinar, let's discuss it again. And then once the price created its first correction move or its first pullback, let me just change the color of this one. So let's try using yellow, and let me just make it thicker. Okay, so here is our first pullback or our first correction move. So this is what we call this low, this move right here. So this is the 2. Okay, so again, this is the 1 and this is the 2. Okay, so once the price breaks this previous high, so this will be our 3. And if you look on our live chart, so we can see that the price breaks this resistance, this previous one right here. So you can see we can put a horizontal line into it. So once the price breach that level, then this move right here will now be our 3. So the completion of our 1, 2, 3 pattern is now complete, right? So this is what we can see on an uptrend. And then as we can see, this move continued all the way up to this level. Okay? So this is what we can call an uptrend. And for you to be able to identify an uptrend quickly, all you have to do is to zoom out your chart like this. And then once you saw that the price is going up, then obviously you are on an uptrend. Okay? So in this case, we can see that if we zoom out our chart, we can see that the price is obviously going down into this level or into this section. So in this case, we have a downtrend. So for a downtrend, this is the opposite of the uptrend. So first, we have this high, and then we have this low. And then once the price created its lower high and lower low, then this will be our 1, 2, 3 pattern for a downtrend example. So in this case, we can see that we have that one right here. So let's start here at the top. So this is our high, and this is our low. And then we can see that the price breaks this previous low, and then it created its first move, its one move. And then we can see that the price created its first pullback right here, which is our 2 move. So we have now our 1 and 2. Then once the price breaks this level, again, you can put your support level right here. Once the price breach this level, then this will now be our 3. Okay, so this is the completion of our 1, 2, 3 pattern. Okay, and this is the pattern that I am using on my personal account, on my own trading, and this is what I've been using for the past 6 years on my personal trading. And lastly, we have this sideways move, or the consolidation. So in case you are seeing that the price is just going nowhere like this, then this is what we call a sideways. So in this case, we can see that we have it right here. So as we can see, the price came from a downtrend. Then after reaching the support level, we can see that the price just created a move like this, right? So in case you are seeing movement like this on your price action, then all you have to do is to just avoid this chart, avoid this currency pair, because trading sideways is not profitable for other traders, while other traders are also trading this range. This is what we call a range trading. But if you are a beginner, then just focus on the trending markets, which are up and down, uptrend and downtrend. In case you are seeing a movement like this, then just avoid trading this consolidation at all. Okay? So to continue, after analyzing the 3 types of market trends, now we are going to discuss the phase of the trend. So we have accumulation phase. So this is what we can see after a downtrend. And then we have this unabsorption phase. So this is what will happen after the accumulation phase, of course. And then we have this distribution phase, which is appearing after an uptrend or after the absorption phase. Okay, so in this case, we can see that we have this downtrend. We came from this downtrend. Okay, so we have this 1, 2, 3 pattern. Then after reaching the support, the price created its first accumulation phase right here. So every time that you are seeing that the price is now on accumulation phase, then there's a high probability that the price could reverse. So this is the first thing that you may want to consider if you want to trade reversals. First is you must look for an accumulation phase in case you are you came from a downtrend. Okay, so in this example, we can clearly see that we came from a downtrend. Then the price created a sideways move right here, and this is an accumulation phase. right? So as we can see right here, this accumulation phase came from this downtrend, and then once the price breaks its previous high, so in this case we have this resistance right here, which is our recent swing high, right? So after coming down, after creating a downtrend, the price formed an accumulation phase right here. And then we can see that the price established a strong resistance above here. Okay. So what you can do is, if you want to trade in this phase, all you have to do is to first look for the the shape of the price action. So first thing that you want to look is for the price action to change its narrative. So from lower low to higher low. So in this case, we can see that the price is creating a higher low right here, right? Then after that, what you can do is to look for a breakout from our previous resistance. So this is what we can do, or this is how we can trade the accumulation phase for a possible reversal trade. And then in this example, we can see that after breaking out from this level, we can see that the price goes up. The price goes up to 33 pips. So if you are on a 5-minute time frame, then 33 pips will be a plenty of a move for you if you are trading or if you are a scalper like me. Okay, so in my experience as a scalper, once I reach 5 to 8 pips, then that's good for my take profit level, because most of the time your stop loss could be 4 to 6 pips. Okay, because you are just scalping. Okay, so that's how we can trade the accumulation phase. And then the second move, or the second phase of the trend, is the absorption phase. And this is what we can see. So after this accumulation phase, so we have this absorption. And then the last phase is the distribution. So the logic behind this is, let's say that the price of an asset is going down. So we all know that the price of any market out there won't go down forever, right? So there's a time that the sellers will be overpowered by the buyers. So that's why an accumulation phase is happening. Then once the accumulation phase ended, then we will go on to a new trend, which is an uptrend. Then after the sellers overpowered the buyers, or let's say the buyers took their profit, let's say the sellers are coming into the market, then the distribution phase will happen. And then after the distribution phase, then a new trend will emerge. Okay, so this is the logical explanation behind these three types of or three phases of the trend. So in this example, we are going to look at the distribution phase right now. So here, this is a good example. So we are coming on an uptrend right here. So as you can see, we have this movement, and then we form a 1, 2, 3 pattern here. And then after reaching this resistance, so maybe the buyers already took their profit here, and then sellers are now overcoming the or overpowering the buyers. So in this case, we can see that there's a new phase has emerged, which is the distribution phase. And then as we can see, the price just moves sideways. So this is what we are saying earlier. In case you saw that the price is just moving sideways, all you have to do is just to avoid this movement. So what we can do again, just like what we did on the accumulation phase, so what we can do here is to identify the support level or the recent swing low. So in this case, we have this recent swing low right here, and this is our recent support. Okay, so in this case, what we can do, just like what we did on the accumulation phase. So just trade the breakout. So this is what we can do here. Trade the breakout, and we can also see that we have a change of market or price action, shift of price action pattern from higher low or from higher high. So as we can see here, the price is creating a consistent higher high. But after the distribution phase, we can see that the highs are getting lower. So in this case, this is another confluence if you want to trade the reversal. So after the breakout happened here, as we can see, the price breaks this previous low. So of course, what we can do is to put our stop loss just above the swing high. So in this case, we can see that the price goes up or goes down. So this is a huge move. The price goes down up to this level, which is 140 pips. So very unusual for a 5-minute time frame. Okay, then again, there's a new phase right here, which is again an accumulation phase. So an accumulation phase happen again right here. So we can draw our resistance right here, and then the price breaks it. And after breaking this resistance, the price goes up again, and then we can see that the price after the breakout, the price goes up to 47.9 pips. All right, so that's how we can trade the three phases of the trend. So first, again, is the accumulation phase coming from a downtrend, and then the distribution phase coming from an uptrend. Okay. So for our next point, in this point, what we are going to discuss is about trend lines, okay, or about trend. How to trade the trends. So this is very important because you're just like the old saying goes like this. It says that the trend is your friend, right? So this is why it's very important to ride the trend. So instead of thinking that the price is too high and you are trying to fight the trend, why don't you just ride it, right? So let's try to look at a cleaner chart. So let me just find one. So here in the Aussie Swiss, so this is a cleaner chart than before. As you can see, we have a downtrend here. So in this case, this example use a trend line for an uptrend. So let's just replicate that one. So we can use this one right here. So in this case, we have this uptrend. And if we are just right here, so what we can do is to use a trend line to connect the lows. And once you connected 2 to 3 lows, then this is a pretty good uptrend, or this is a pretty good trend. So in this case, what we can do is to look for a 1, 2, 3 pattern, combining with trend line. So in this case, we have this 1, 2, and 3 pattern right here. But the breakout of this previous one isn't that a huge breakout. But we can also see that we have a breakout buildup right here. So by the way, breakout buildup is something like this. So in case you saw a 1 and then a 2 move, and then you saw that the price is creating a movement like this. So this is what we call a flag or a pennant. In this case, the price is creating a higher low while it's creating a lower high. So this is what we call a flag or a pennant. So in this case, this is also a continuation pattern, and we are going to discuss this one, I think, right here. So yeah, so let's just discuss this one real quick. So again, once you saw that the price is creating a movement like this, so what you can do is to wait for the breakout. So let me just clean this one. So in this example, we can see that the price established a resistance right here. Then as we can see, we have this breakout build up. So coming from this low, we can see that the price is forming a higher low right here. So in case the price breaks this resistance, then there's a high probability that the price could go even higher because of this build-up. So that's the logic behind it. Is there's a willing buyers that are buying, or they are constantly taking a long trade every time that the price is trying to go down. Okay, so in this case, the breakout traders could take a long trade once the price breaks this resistance because of this build-up. Okay, and then as we can see, after breaking this resistance level, the price goes up to this level right here. And if we take a look at it, the price goes up to 16.5 pips. Okay, of course, not every one of us likes to trade a breakout. Some of you prefer trading pullbacks, and in this case, you may want to wait for this pullback to happen. So a lot of pullback traders are using this previous one or this previous resistance to act as a new support. And then what you can do is to put your stop loss just below your build-up structure right here. So in this case, so let's say we bought into this pin bar, and then we put our stop loss just below our build-up structure like that. So in this case, we will have 7.7 pips. So this is what I am saying earlier. In 5-minute time frame, the normal stop loss placement, or the normal calculation for your stop loss is around 4 to 6 pips. So in this case, we have 7.7 pips. So for you to be able to determine your take profit level, then you can use your previous high, which is right here, or just use 1:1 risk to reward ratio, just like this. Okay, so that's how we can trade the uptrend. And for a downtrend, it's just the same. So for example, here we have this 1, 2, 3 pattern, and then we can see that the price pulled back. So other traders are also using Fibonacci retracement. So in this case, coming from your previous high, which is your 2. Okay, again, this is your 1, 2, and 3 move. So coming from your previous 2 or your previous high, what you can do is to pull out your Fibonacci retracement. So click onto your previous 2, then drag it down onto your nearest or your recent low, which is your 3 move. Then click into it, and then look for your Fibonacci golden zone, and we can see that this is where the price is reacting. Right, so as we can see, we have this pin bar right here, and we have this big engulfing candle, and we can expect for the price to go down because the price already reached its resistance, which is the golden Fibonacci zone. Okay, so hello army lover. So later we will try to analyze the gold. Okay, so just stay with us here. So to continue, again, we have these 3 market trends. So the first is the uptrend, downtrend, sideways, then again uptrend, and downtrend. Okay, so to continue, this is what most traders are using, which is chart patterns. So a chart pattern is a graphical representation of a price movement. So by using a series of trend lines, so just like what we used earlier, trend lines or curves, such as the 1, 2, 3 pattern, chart patterns are the foundation of technical analysis. So once you learn how to identify a trend, how to identify your price action, then it will be very, very simple and easy for you to trade. Because if you don't know how to look or how to read a chart, then it will be difficult for you to decide, right, whether to buy or sell. So that's why chart patterns are very, very important. But of course, they aren't bound by any scientific principle or physical law. Their effectiveness highly depends on the number of market participants paying attention to them. So they are caused by several factors, including human behavior. So again, chart patterns or technical analysis is not your holy grail, because there's no holy grail at all in trading, right? So we all know that technical analysis is just your tool, your it is just a tool that a trader can use to decide whether to buy or sell. Okay, it is not something like magic that will give you a lot of money, right? It is just a tool for you to be able to decide whether you want to go long or short on a specific currency pair. Okay, so these are the two types of chart patterns. So first is the continuation, and then and then we have these reversal chart patterns. Okay, so continuation patterns help traders to identify opportunities to continue with the trend. So this is what I showed you earlier. If you want to trade with the trend, then you may want to look for a continuation pattern. Okay, so the most common continuation patterns include triangle, flag, and pennant. So if we look into this at the live chart, so for example here in Aussie Swiss, so let's try to look at the patterns first. So here we have a flag pattern, and in this case, the flag pattern occurs when a sharply trending price suddenly pauses and retraces slightly in a rectangular range. It then breaks that range and continues in the original direction. So giving you the opportunity to enter the second half of the trend at a better price than before after the flag has formed. So in this case, we can see that we have this one move, right? And then the price created its two move. Then in this case, we can see that it is not moving like this, right? The price is showing us some movement like this. So in this case, we can put a trend line like this. So as you can see, we can put a trend line like this into this pattern. And then once the price breaks this trend line, then that's the perfect time for us to look for a trading opportunity. Or other traders are putting a box into it. So this is what we call a Darvas box. Then once the price breaks the top of the box, so for example, we have this movement. So other traders are putting trend lines, okay? But other traders prefer using Darvas box. So there's no right or wrong into this method. You can use anything you would like. So in this case, for example, you saw that the price breaks the trend line, then you may want to look for a buying opportunity into this breakout of the trend line. Okay, but if you prefer trading breakouts of the top of the box, which is right here, then you may look for a buying opportunity once the price breaks this resistance or this top box. And then on a downtrend, it is just the same. So we have this one move, and then the price created a movement like this. So you can put a trend line, or you may use a Darvas box. So once the price breaks this trend line, then you can put your short trade here, or you can also wait for the breakout of this box at the bottom of the box. And then if in this case, you will put your short order below here. Okay. So looking at the chart, so let's try to identify some flags right here. So this is a very good example. So in this case, so we have this 1, 2, 3 pattern, right? And then the price pull back. Then after pulling back, the price didn't just pull back like this. So if we are going to compare this pullback, so this pullback is just a straight pullback, right? So this is just a straight pullback. But in this example, we can see that we have this movement like this. So this is what we can call the flag pattern. Okay, so we can put our trend line like this. And then in this case, what you can do is to look for a breakout trade from this trend line. So as you can see, the price breaks this trend line with this green candle right here. Then after breaking this trend line, the price goes up to this level. Then if you are not comfortable taking a breakout from the trend lines, then you may want to use a Darvas box. So in this case, this will be or this could be the trading opportunity that you can use if you don't want using trend lines. So in this case, we can see that the breakout happened with this candle. And then if you bought into this level, then the price goes up to 17.8 pips. But if you took a breakout trade from the trend line, then the price goes up to 22.9 pips. So there's the difference into it. So if you want, or if you are more comfortable trading breakouts from the trend line, then you may use flags. But if you are not comfortable taking breakout trades from the trend lines, then you may want to use Darvas box instead. Okay, so that's how we can use, or that's how we can trade the continuation patterns. Then we have pennants. So this is just like flag and pennants are just the same. As you can see, we have another example right here. So this is R1 and this is R2. Then we can put our trend line. Then the breakout happened here with this candle. Then the price goes up to this level. In a downtrend move, so we have this one, and then we have this two. We can put trend line. Then after the breakout, we can take a sell trade here. And then as we can see, the price continue to go down. All right, so that's how we can trade continuations. And then finally, we have these reversal chart patterns. So in this case, reversal chart patterns are like, for example, we are on an uptrend, and then we saw that the price is now failing to break its previous high right here. Okay, so this is the first indication that the price could reverse, right? So every time that you are seeing that the price is making a failed swing like this, so this is your first lower high. Okay, so this is your highest high in which the price is failing to break, right? And then once you saw a failed swing, which in this case lower high, so this is the first sign that the price could make a reversal. Then what we can do here is to look for a breakout from this previous low and this previous low down here. Once the price breaks this level, then this is a confirmed breakout, and this could lead into a possible reversal. Okay, so in this case, in this example, we have this double top, and in this example, we saw that we have this failure to break this previous high right here. Okay, so this is what it looks like on a chart. So first, we have this 1, 2, 3 pattern. Then after the pullback, the price tried to break its previous high, but then it failed to break it. Then after the failure of a breakout, what we can do again is to anticipate a breakout from this previous low for a possible reversal pattern. Then once the price breaks it, and this is the confirmation of a reversal. So this is what we can see right here on this example. Okay, so if we take a look at this on the live chart, so let's try to look for a good double top pattern. So double top normally appears on an uptrend, of course. So let's try to look on other currency pair. So here, this is a good example. As we can see, this is a huge move coming from the high impact news that we analyzed earlier. Then as we can see, the price created its first pullback. So after this huge move, the price created its first pullback. As we can see, we have this pattern. So this is the downside of trading trend line breakout, because as we can see, there's a chance that the price could make a double top. So after just breaking this trend line, we can see that the price failed to break this previous top. So in this case, this is what we call, or this is the completion of the double top, right? And then in this case, again, what we can do is to put a horizontal line on our neckline. So this is what we call a neckline, the previous low. Then after the price breaks it with this candle, so this is the confirmation right here. This breakout candle here is the confirmation that the double top has succeeded. And in this case, we can see that after breaking this neckline coming from a double top, we can see that the price goes down. And it went down up to this level. So coming from this breakout of the double top, the price went down up to 173 pips. So a huge move coming from that double top pattern. Okay. So let me show you a sample trade that I took from the Aussie dollar using in this case, the double bottom. So this double top is always appearing on the on an uptrend. So in this case, an uptrend is or we can see an uptrend, and then the price failed to break its previous high, and then the price breaks its neckline, then that's we call a double top pattern. So for the next example, we can also see, or we can also identify a double bottom. So in this example, we have a downtrend. Okay. Then after creating a series of lower highs and lows right here, so we have these lower highs and lower lows. Then once the price failed to break its previous low right here, so this is the first indication that a double bottom is happening. So we can put our neckline right here, and then once the price breaks this neckline, then we can take a buy trade into this breakout. Okay, so again, a double bottom is a failure of a breakout from its previous low, and then once the price breaks its neckline, then that's a good reversal, a pattern for us. So this is like a W pattern, and then the double top is an M pattern. Okay, and if you look on the Aussie dollar, so we have this double bottom right here. So as you can see, we came from this downtrend. So we have this 1, 2, 3 pattern. But in this price action right here, or in this case, we can see that the price failed to break its new low, or its recent low right here, right? So in this, once I saw this, I put my trend line or my neckline here. But I am not comfortable trading breakouts. That's why I waited for the pullback, and I waited for a new 1, 2, 3 pattern to the upside. Then once I saw it, I took advantage of it. So as you can see, this is how we can combine the 1, 2, 3 pattern with the breakout of a double top or bottom. As we can see, we have this double bottom, right? And then we have this breakout of this neckline. Then after seeing the breakout, I waited for the price to form a 1, 2, 3 pattern. Then as we can see, the price formed a 1, 2, 3 pattern right here, just after breaking this neckline. And then the price created another pullback right here. And then we can see that after pulling back into this level, the price goes up again. The price goes up again, until it reach its previous high right here, right? So again, this is another, as we can see, this is another double top, right? And then we can again draw our neckline right here. So in this case, we can see that we have this breakout buildup. So this is how we can combine all of the things, or all of the patterns that we are studying so far. So in this case, we can see that before breaking this neckline, we saw a breakout buildup. But in this example, on the double bottom, the price just instantly break its neckline without creating a buildup. So in this case, if you saw that there's a buildup on the breakout point, so this is our breakout point, right, which is our neckline. So every time that you are seeing a buildup, then a breakout trade will likely be successful. But in case that there's no buildup like this, in case that the price just went right into this support, or into this neckline, without even creating a buildup like this, then the the likelihood for that breakout to succeed is lower than this. Okay, so that's why I didn't trade the breakout of this double bottom. Okay, so in this case, I waited for this 1, 2, 3 pattern to happen first. And then after seeing that the price is pulling back again, so what I did is I use Fibonacci tool. I use this Fibonacci tool, then I saw that the price reacted into this Fibonacci golden zone. Then in this doji, this is where I decided to buy. Okay, so that's how we can trade reversals and continuations. So again, this is an example of a double bottom. And this one right here is an example of a double top with a breakout buildup into it. Okay. So moving on, now we will study about the head and shoulder pattern. So this one, head and shoulder pattern is a bearish reversal pattern that is described by 3 peaks. Okay. So the outside two are close in height, and the middle is the highest. So in this case, we can see that we have this first move. So this is R1, this is R2, and this is R3. So this is a good pattern of an uptrend, right? But keep in mind that a head and shoulder pattern is a reversal pattern. So coming from an uptrend, you may look for a reversal pattern once the price created failed swing right here. So remember the failed swing. This is our previous high in which the price failed to break, right? It didn't even came close into our previous high. So the price created a lower high right here. So we can also put a trend line into it. And then what we can do is to put a neckline into this level. Then once the price breaks this neckline, then we can take a sell trade into this breakout. So it is just something like this, a 1, 2, 3 pattern first. And then once the price created a pullback and then created a failed swing like that, so we can identify that this is a head and shoulder pattern. So this is our left shoulder, this is the right shoulder, and this is the head. Okay, and then we can put our neckline into this, or we can put a trend line. And then once the price breaks this neckline or this trend line, then we can put our sell entry or our sell trade into this breakout. So other traders are also waiting for a pullback like that. So nothing wrong with that. Both strategy is good. Okay, so let's try to look for a real life example of a head and shoulder pattern. So this is a good example. So coming from a downtrend, so we have this 1, 2, 3 pattern. And then the price even breaks this previous high. So this is also a good indication that the price will going to reverse. But in this case, we can see that we have this left shoulder and then right shoulder here, and this is our head, right? And this movement right here is what we can call the failed swing because it didn't break this previous low that we have right here. So what we can do here is to look for our neckline, which is this previous high, and then take a breakout from it. Or we can also use some combinations of our chart patterns that we learned earlier, which is a flag. So you can see in this case, we have a flag pattern, right? So we have this flag pattern. So if you are comfortable trading breakouts from the trend line, so this is a beautiful trade for you to take advantage of this reversal pattern. So in this case, we can see that the price goes up to this level. Okay. And then we have another head and shoulder pattern right here. So in this case, we have an uptrend. So we have this 1, 2, 3 pattern. Then the price created a failed swing right here. So this is our left shoulder. This is now our right shoulder, and this is our head. And then as we can see, we can clearly put a trend line into this level, and this is what I am saying earlier. If you want to trade breakouts, then you can put you can open a short trade here on the breakout of this candle or on the breakout of this neckline. But if you prefer trading pullbacks, then you may want to wait for this pullback right here. Okay, so nothing wrong with that. Both strategies are working. So in this case, we can see that after breaking this neckline, the price drops up to 11.3 pips before continuing to before trying to go up again. And then we can see we have another reversal pattern here, which is a head and shoulder. So this is our left shoulder, our neckline, our head, and then our failed swing, which is our right shoulder. And then we can put our neckline either a trend line like this or a horizontal line like this. And then we can see that after the breakout happened here, the price goes down up to this level. Okay, so that's how we can trade the double top, double bottom, and reverse or head and shoulder patterns. Again, these patterns are reversal patterns. Okay, coming from an uptrend, once you saw that the price is creating a failed swing like this, then this is the first sign that the price, again, this is the failed swing because this is the first lower high, right? This is our last highest high, and then this is our first lower high. So in this case, we can expect that the price is now losing its momentum. It's losing its momentum to the upside. So we can anticipate a breakout from its neckline down here for us to capitalize on a possible reversal. Okay, so other traders again are comfortable taking breakouts, while other traders prefer trading the pullbacks like this. Okay, so in case you want to trade the breakout, what you can do is to look for this structure, this previous low, this previous support to become resistance, or you can also use Fibonacci retracement. Okay, so that's how we can combine all of the things that we are learning so far. Okay, so here these are beautiful examples right here coming out of the head and shoulder pattern. So here, as we can see, again, we have this 1, 2, 3 pattern, and then a failed swing right here. The price didn't break this previous low. And then we can see that we have this neckline. The price breaks it. So you can either buy into this breakout or buy into this pullback for a possible continuation to the upside. Okay. Then, of course, we can also use some indicators into it. So for example, here we have this moving average. So let me show you how to combine indicators with chart patterns. So in this case, let's use 20 and 50 moving average. So in this example, most traders prefer trading the crossover, right? So if you are one of the traders who are using crossover, MA crossover, please type yes in the live chat box, because we are going to discuss this one. So in this example, we have this pattern, which is a head and shoulder. So for us to be able to capitalize on this movement, again, what we can do is to look for a breakout of this trend line. And then once we saw that the price is, or the indicator, our indicator is crossing, or it is now creating a crossover right here. So this is the first sign that the price could reverse, right? So other traders are using some of this method together with the breakout of this trend line, right? So as you can see, this is a very, very good confluence. So we have this breakout, or we have this crossover from this MA, which is the 20 and 50 EMA in this case. So we have this crossover, and then after this crossover, the price breaks this trend line. So in this case, we can put our sell entry here, and then we can put our stop loss just above the crossover, or this above this MA. And then for our target, we can just use a 1:1 risk to reward ratio for the sake of this example. And in this case, we can see that the price easily reach our target. Okay, we can also use structure as our target. So this support down here could be our target for our TP, and as you can see, the price reach it right here. Okay, so if you look onto the earlier example, so here in this case, we have this head and shoulder pattern, right? And then we have this flag. And then if we use a crossover right here, so first we want to wait for the breakout of this trend line. So we have the breakout right here, but we don't have a crossover yet, a crossover from the EMA. And then once the crossover happened right here, so we have this crossover right here. So then you may want to look for a buying opportunity either from this candle, and then put your stop loss just below your MAs. And then for your target, again, you can use 1:1, or you can use structure for your advantage. So in this case, we have this previous high right here, which we can use as our target. Okay, so that's how we can use indicators plus price action patterns. Okay, so we can also use this RSI. So by the way, there's types of moving average. So in this case, in this example, we have simple moving average. So simple moving average is the simplest type. It is the simplest type of moving average. So instead of looking at the current price of the market, the moving average will give you a broader view. Okay, so just like what I showed you earlier. So this right here is a good indicator for us to take advantage of those examples. Okay, you can also use a single MA. So for example, we want to use a simple 200 MA. So let's try to use 200. So here, for example, we have this. So let's try to look into this one earlier that we have right here. So for example, we have again this reversal pattern. And this is a very good confluence. As we can see, the price breaks its neckline together with the 200 MA, right? As we can see, this is a very good confluence, a breakout from our previous low, which is our neckline, together with the MA. In this case, this could be a very, very good breakout trade for us. So let's try to look for another example. By the way, MAs is a good filter for trend trading strategy as well if you want to trade continuations. So in this case, we can clearly see that the price is consistently trading below the 200 MA, right? And we can see that we have a 1, 2, 3 pattern here. And so in this case, we can use this indicator for us to take advantage of the trend continuation trades. Okay, so we can use it on trend continuations as well as on reversals. We can also use it as a breakout strategy. So in this case, we can see that we broke out, the price broke its previous high right here, and together with that, the price also breaks its MA right here. So together with this structure, you also have this MA. So this is a great confluence for a buying opportunity, right? So again, we have another breakout from our previous low right here. So this again is a very good reversal pattern, a breakout from a previous low. So you don't want trading sell trades yet with this breakout alone. What you want to consider is for the price to break the MA. So in this case, the price breaks the MA right here. So if you put or if you took a sell trade here, and as we can see, this is a very good strategy as well. Okay, so that's how we can use indicators or MAs. So now let's take a look at the RSI. So this is one of the most popular indicators. So every time that the RSI is making an overbought or an oversold, then that's a good indication that the price could go up. So in this case, we can see that let's try to look on the continuation. So for example, here we have this pullback, right? So we have this 1, 2, 3 pattern. So we have this 1, 2, 3 pattern here. Then the price pull back. So the price pull back, I believe it is on a Fibonacci golden zone. So there's we can see the price pull back on a Fibonacci golden zone. And then using this price action together with the RSI, so we can see that this pullback right here is also a pullback on the RSI, right? So once the RSI pulled back and it went down below the 50 level, so this is also a good indication that every time that the price is pulling back, so again, just because the price is overbought or oversold doesn't mean that the price will make a reversal. Okay, because most of the time, as we can see right here, the price is consistently reaching or touching this 30 level, right, which is the oversold, right? But as you can see, we didn't get any reversal from our price action, right? So it is very, very important to note that it is better to use the RSI for a continuation. So in this case, again, we have this pullback coming from our price action. The price pulled back from our Fibonacci golden zone, and then we can see that the RSI also pulled back. And then what we can do here is to look for a breakout from this MA from our RSI. So as you can see, this yellow line right here is the MA. So what you can do is to look for a breakout into this MA. As you can see, we have this breakout right here. Okay, so together with this breakout from the MA of this RSI, we can also use it as a trigger from an entry from our price action. So as we can see in this case, we have this pullback from our Fibonacci golden zone coming from or combining with an RSI. We also have a breakout from the MA. So in this case, we can put our buy entry here, and then we can put our stop loss just below the entry price or the entry candle, and then we can put our TP for a 1:1 risk to reward ratio in this example. And as we can see in this case, the price easily reach our target with just 3 candles. Okay, so that's how we can use indicators. That's how we can combine indicators with price action. Okay. All right, so moving on. We also have the exponential moving average, by the way. So let's just discuss this real quick. So SMA or simple moving average is slower. Okay, so take note of that. This is slower, but it is smoother when responding to the price action. So when looking at a longer time frame, it could give you an idea of the overall trend. While the EMA or the exponential moving average helps you catch trends very early. So while SMA is slower, then EMA is moving earlier than the SMA. Okay, so let's say for example, the price is moving up and then the SMA is catching or trailing the price, then it will just react after the price move, but the EMA will likely go with the price action itself. So for example, the price is moving like this and then the EMA will catch it faster. The EMA will catch faster than the SMA. Okay, so that's the difference of EMA and SMA. So let's take a look on the example of the chart. So let's try to put both SMA and EMA. So here we have, for example, let's just use 20 SMA. So here we have SMA. Okay, then let's make it white. So this is our EMA, and then let's try to use EMA. So for our EMA, so this one is EMA. Okay, here this one is EMA, and let's just make it green for you to be able to see the difference. So as we can see, this is the difference of SMA and EMA. As you can see, the SMA is slower. It's reacting slower than the EMA. So as you can see here, the EMA is touching the price. Okay, while SMA is, or the SMA has some allowance or has some gap into the price action. Okay, because it is moving slower than the EMA. And then here on the reversal pattern right here, we can see that the EMA is also a very good indicator for you to be able to ride this reversal pattern. It is also a good indicator because we can see that it could be a support, right? So as we can see here, it is acting as a support, or a dynamic support. Unlike the SMA, we can't clearly see whether the price will end its pullback or not. But of course, there's always a downside. The downside for the EMA is that you might get a fake out. Okay, so you might get a fake out like this, just like what we have here. So here, this is a good fake out. So here, this SMA right here, this white MA. This is remember, this is our simple moving average, or our SMA. As we can see, this is a good pullback trade. But if you use the EMA, then you will get this fake breakout. Okay, this false breakout from the price. Okay, because as we can see, the price breaks this EMA, but after breaking the EMA, the price continued to go down. Okay, so that's the difference and the advantages of SMA and EMA. Okay, so having said all of those things, let's now um, try to do some quick tests if you learned something for today's session. So you may freely answer all of these questions on our live chat. So what does BOJ stands for? So again, everyone is free to answer on our live chat box. So what does BOJ stand for? Hello, Rajat Gupta. The RSI setting that I showed you earlier is just the default setting. Yes, a 5-minute time frame is good to trade, especially if you are a scalper. Again, what do you think BOJ stand for? So two of the participants, or three of the participants said Bank of Japan. So how about the others? Do you think BOJ means Bank of Japan? All right. So if you said Bank of Japan, then you are correct. Okay. So the second question is, where does the inverse head and shoulder occur in a trend? Again, where does inverse head and shoulder occur in a trend? Is it downtrend or uptrend? Hello, Papu Boy. You can use um, ATR for you to be able to identify where to stretch out your stop loss. Hi to you as well, Troy Tayaba from Manila, Philippines. Again, where do you think the inverse head and shoulder occur in a trend? Okay, so if you said downtrend, then you are correct because this is the normal head and shoulder, right? It is from from an uptrend, but the inverse of it is like this, which is on a downtrend. It is appearing on a downtrend, right? Again, this is the normal head and shoulder, and the inverse head and shoulder looks like this. Okay, And for the last question, name two continuation chart patterns that we discussed today. Hello to you as well, Zen Trade from Nepal. Again, please name two continuation chart patterns that we discussed today. Hello, Irfan Bashir. So I would like to invite you to join us on Friday because we are about to end for today's session. But we're glad to have you here. All right, so two of our continuation chart patterns that we discussed today are just like what Shailandra at 99 and Home Sweet Home commented is triangle and rectangle. So triangle is just like this. So for example, on an uptrend, we saw a 1, 2, 3 pattern, and then you saw a pattern like this. And then the other one is we can, let's just say Darvas box, right? So after the one move, then the two move came, and then you can put a box into your previous high and low. Okay, so having said those things, let us now move on our Q&A session. So if you have some question, then you may ask on our live chat box right now. And if you want to take advantage of the 100% deposit bonus, then you may use the promo code PaulJM100. Okay, again, it is PaulJM100. Okay, so take note that this promo code is valid until May 31 only. So if you want to take advantage of the 100% deposit bonus, then you may want to um, add onto your funds before May 31. Okay, again, it is PaulJM100. All right, so if you have some question, then you may ask some question on our live chat box, and I will try to answer your questions as much as I can. And by the way, we have someone here with us who is asking to analyze the gold chart. So let's try to look at gold. And he said 1 hour time frame, if I'm not mistaken. So hello, Army Lover 007. If you are still with us right now, so can you please tell me which time frame do you want for me to analyze the gold? So this is what we have from the daily time frame. So the trend is up. Hello, Papu Boy. The next webinar will be on Friday. Thanks, Home Sweet Home. I'll definitely do it. God bless you as well. And I hope to see you again on Friday. Okay, so here for the gold on the daily time frame, we can see that the price is now approaching this resistance level, or the price already touched it. And because the price reached it, the price created a pullback. So right here. So we can expect for this one to maybe retrace a little bit, because we can see that we have this 1, 2, 3 pattern. So we can expect a movement maybe down into this previous resistance that could turn out to be a new support for this price. But as we can see, we have an engulfing candle right here. So this could be the start of a continuation to the upside. But if the price decided to pull back deeper, then we can expect for the price to reach this previous resistance, and this could be our new support. Okay, so that's what I am seeing from the gold. Then if we look down further, we can also see some imbalances right here, some imbalance right here. So if the price breaks this support, this first support, so this is our first support. If the price breaks it, then our second support could be down here. Okay. So again, this is our first support, and this could be our second support. So this is what I am seeing from the gold. Hello again, Papu Boy. So on Friday, it will be 7 p.m. Manila time. You are very much welcome, Shai Elendra at 99. Yes, Nolanadores, you may also want to watch our past webinars. So that past webinars consists of 8 complete webinars, beginning with the fundamental, basic fundamentals of Forex, up to the some advanced technical analysis, like what we use today, such as Fibonacci retracement, the accumulation, distribution phase. We already have those webinars from our past session. So you may, I would like to encourage you to please watch those webinars if you have time. You're very much welcome, Papu Boy. Hello, Irfan Bashir. So for you to be able to decide on which time frame to use, you may want to ask yourself first. If you want to be a swing trader, then you can consider trading on the 4-hour time frame. If you want to day trade, then you may want to use 30 minutes or 1 hour. So maximum 1 hour and minimum 30-minute time frame. But if you want to scalp, just like me, I am more of a scalper, and I am using 5-minute time frame. Because in this time frame, in 5-minute time frame, you will see a lot of patterns and a lot of opportunities. So for example, here in this example alone on gold on the 5-minute time frame, you won't see this on the higher time frame, right? You have a 1, 2, 3 pattern here, right? So in this case, as we can see, the price pulled back into this previous one or this previous resistance, and you can take advantage of this pullback right here. So you can buy into this level. So something like that. So if you want to scalp, then you may use 5-minute time frame. But most of the traders or swing traders, they are using daily time frame for their analysis, and they are taking the trade on the 4-hour time frame. You are very much welcome, Lolita Zara. So I hope to see you again on Friday for our last webinar. So on that webinar, we are going to discuss steps on trading the market, key levels, risk management tips. This is very important in trading, as well as entry and exit options. So in this session, I will teach you on how to identify the a good placement for your stop loss. All right. If you have any other question, please don't hesitate to put it on our live chat box. Thanks as well to you, Sir Nolan Adores. I hope I am able to bring value to you today. You are very much welcome, Irfan Bashir. Hello, Alan Tai. So again, this is what I am seeing on the gold market on a daily time frame. So the price just reached its resistance, and then the price is now pulling back. So we have this engulfing candle, but I am expecting that the price could go down lower, maybe into this first support. But if the price didn't respect this first support, then this right here could be our second support. So about the amount that you should start, so it is up to you. If you are comfortable trading on $100 account, then I encourage you to do that, because I am sure, or I am um 60 to 90% sure that if you are just a beginner, then it will likely for you to lose, right? So that's why I don't encourage you to put a bigger amount. So just use an amount in which you are willing to lose. Yes, Irfan Bashir, being a full-time trader is very possible if you achieve the mastery of trading. Of course, it will take a lot of time, but if you are willing to put in the work, just do whatever it takes, then I am sure that you will succeed. I am also hoping to help you achieve that, Papu Boy. All of us are wanting to achieve something in life, right? That's why we are studying, and that's why OctaFX is giving us these free webinars. Yeah, about risk management, Alan Tai. So risk management is very important because losses are part of trading, right? So let me just show you this one. So let me just connect on my paper trading account. So for example, here on my account history, you can see that I am still suffering on a losing streak, right? As you can see here, even if I am trading for more than 6 years now, I am still experiencing some strings of losses. So this is why risk management is very important. So imagine if I risk 10% of my account into this losing streak, then this will cost me 10, 20, 30, 40, 50% of my entire account, right? So that's why risk management is very important. And it is the golden rule in trading that you should only use 1% for each of your trade, because in case you suffered a string of losses like this, then you will only lose 5% of your account instead of losing 50, right? Because losing 50% on your entire account is very, very stressful. And like what I experienced when I was just starting, I lost my entire account in just 2 days. And that was a very, very painful experience. And because of risk management, I was able to turn this $100,000 a paper trading account into, right now, it is sitting on 154,000, right? So I only use the right approach, the right strategy, and the right risk management system. The whole trading system consists of course, the technical analysis, fundamental analysis, risk management, and that's why I was able to make this paper trading demo account to 100,000 up to 154,000 right now. Okay, so that's a 54% increase. And of course, there's also a string of winners. Of course, we can also expect something like this. But in case you are experiencing some strings of winners, don't be greedy. Always use your risk management approach. The right approach will give you the right result. And the consistent approach in the market will reward you with consistent result, right? I think there's still a draw on Friday, home sweet home. So thank you for sharing us your experience that you are losing your account. You blew 3 accounts in 4 months before. Then after watching our webinars, then you are able to earn right now, you and your family. Thank you for sharing your experience. It is a valuable um, experience for your co-traders, especially the beginners, that it is possible for you to be able to be successful in forex trading, right? So just like home sweet home is saying, he was able to turn things around because he achieved some levels of mastery after watching our webinars. He achieved this the knowledge that he was looking before, I guess, right? And as we can see right now, he was able to make some consistent returns from his portfolio, which is a very, very good example if you are willing to put in the work, right? So congrats to you, congratulations to you, home sweet home, and to your family. All right, so I guess that's it for our session for today. So once again, this is Paul Mendoza, your trading speaker. Bye.